Good morning. You're watching The Market right here in 18 now with me, Asha Faridi, Aman Dabash, Nikunj Dalmia in the studios. And a range-bound market yesterday. In fact, a very narrow band from the high to the low of the day. You did see support from a Reliance Industries, from an HDFC Bank, but again, not a rara move really. So we consolidated around the 19,800 mark for the large part of today's trading session. But really, tested that level and just about closed in around that. Small caps, of course, that's where the rally continues, and it's staggering the move that we've seen on the PSE index, Nikunj, which is at a life high.
Yasha, there is nothing wrong with the market setup.
Yeah.
Now we can talk about Nifty not moving in line with the small cap index, or we can talk about FIs they are selling, but that's not the right way of looking at the market. For me, I think the market setup is constructive. For me, the participation level from the local, from the retail and from the domestic institutional investors is more than satisfactory. And if one looks at this trader screen, the global cues are not bad at all. So the flows are positive. F&O position long built up is evident. The construct of the market is such that more and more stocks are rotating, and the bearishness in the market, which was supposed to happen because of geopolitical concerns, markets have shrugged them away. So yes, we may have not made a new high on the index, but we certainly have made a new all-time high in terms of the small cap index. So the positioning of the market is very clear, which is what we've been maintaining, that the path of least resistance is on the upside. I think it's because of technical factors that the Nifty is doing nothing. We'll talk about it. But for me, I think in last couple of days, the market setup has surprised everybody, and the way equities as an asset class have simply held on. I think it's a clear indication that right now the bulls are back in the driving seat.
Yeah, and you haven't gotten any large, big disappointment from earnings so far, early days yet, barring IT, which was pretty much in the price.
No earning disappointment. Look at the global setup. Dow earlier this week closed above the 200 DMA. So markets are pretty much getting what they are expecting and what they are anticipating. There are no surprises. Now at this juncture of the market, what markets cannot handle is a negative surprise. And thankfully for us, we've not had a negative surprise. The commentary up until now, which you've got even from HDFC Bank, even though it's a underperforming stock, actually has not been bad. Bajaj Finance, we'll talk about those numbers. Clear play, or it's a clear mirror on which way NBFC and the retail book is moving, I think was more than impressive. IT companies, yes, they have a near-term pain, but long-term, I think they will also make a comeback. While these early days in the earnings season per se, but I think markets are more than satisfied with what they've got in terms of the earnings handover, so to speak, right now.
Yep, as you said, perhaps it's going to be just, short-term pain when it comes to the IT basket. Just a quick check-in on the rest of the globe, and for the most part, it's been a bit of a mixed basket for Wall Street as well as for Asia. You have China data as well coming in with 4.9% growth in the third quarter, and that has been stronger than what was expected. Nikkei, Hong Kong, Shanghai in the red, the Kospi and the Australian markets holding out in the green. But if we look at our markets in the context of valuations, just put into perspective some interesting data, what the current valuations stack up at, what it's been at the start of the year, as well as what the overall 5-year average was. And just looking at that picture, Nikunj, when it comes to the broader markets or even the frontliners, it's been pretty much status quo in terms of the overall valuation, and at 19.7 times, how should one really be reading into it?
Now that's where the gray area is. I mean, I'm not saying it's like the red light, but it's certainly not a green light now. It is certainly
Amber.
I mean, even sometimes when you know that amber, I mean, is it the last phase of amber? That's my only problem. Yeah. See, historically, small cap stocks, they should always trade at a discount to large cap stocks. The theory being that big companies can handle cycles, they can handle stress in the economy, and they can withstand the cyclicality, both in terms of business and in terms of economic cycle. Small cap stocks, well, they always trade at a discount, and largely they want to trade at a discount is because they cannot handle cyclicality, they cannot handle business stress. Now, let's stay with this. Why is this important? At the beginning of the year, the Nifty premium was at about 20 times. Currently, it is at 19 times. 5-year average is 22 times. In small and mid-cap stocks, the 5-year average is about 17 times, but you've gone to 18.6 times, and that similar factor is at play now. So the interesting bit for me here is that Nifty which is a basket of large cap stocks, it is trading in line with its historical averages. But small and mid cap stocks now are trading way above their small cap averages. Similarly, if you look at the discount between the small cap index and the Nifty now, it really seems to be narrowing down. In fact, the mid cap index is now trading at a premium to the Nifty. Let's be very clear, it's not going to sustain. Either Nifty has to move up, which is what we're hoping for, or small and mid cap stocks have to come down. By and large, the bargains, I think, in the small and the mid cap space is over now. And that is something you need to now, you really need to unfortunately realize. As a category, don't buy small cap stocks. Focus on companies and businesses if you're looking at investing outside the comfort of Nifty 50. If you are a large cap investor, I think the margin of safety in large cap stocks right now is higher than small cap stocks. I'm not saying that you go and sell your small cap stocks, but you have to be slightly choosy, very, very choosy when you are now making a fresh portfolio in small and mid cap stocks. I always focus on two things, risk and margin of safety. I think at these levels, the margin of safety is not there.
Okay, lots of earnings today. First, of course, we're going to start off by analyzing Bajaj Finance and reacting to that, which we'll dig deeper in just a bit. But you've got Wipro, you've got LTI Mindtree, you've got Bajaj Auto, and I think the big one is going to be IndusInd Bank as well.
See, Aisha, I think IndusInd Bank and Bajaj Auto are important. You know, frankly, from LTI Mindtree markets, it's not going to be a market-moving number. True. From Wipro, expectations are just not there. For Bajaj Auto, because the stock actually has hit a new high and IndusInd Bank has been on this cusp of recovery, so to speak. And we spoke about IndusInd Bank, that, you know, valuations now for IndusInd Bank and ahead of that MSCI inclusion, it really could be an interesting one to look at. Bajaj Auto, what happens to their export market? And has the domestic market really made a comeback? When we spoke to the management last, when we were in Pune, they did indicate that things are looking up and things will only incrementally improve. You do have a situation where right now the divergence between Hero MotoCorp and Bajaj Auto is very high. So Bajaj Auto, if they are able to give a positive communication to the market that they were able to control their margins, their local businesses making a comeback, and whatever volatility we've seen in the export market, largely because 50% of their business now is coming from exports, that has stabilized. So that may really help the market, you know, sentiment per se. Wipro, frankly, from a market standpoint, it is not on everyone's radar. LT Mindtree, important but expensive. IndusInd Bank, curiosity levels are high, and Bajaj Auto has to deliver to sustain the momentum. That's how I look at things.
Okay. In the meantime, let's just address the global setup as well. It's a nothing sort of handover from US equity markets, largely flat pretty much across the board. And Asia, well, you've got that big trigger wherein China has posted a 4.9% growth in the third quarter as opposed to 4.6% that the analysts on the street were expecting. So it's a big beat coming in for Chinese GDP data. We're not really seeing any enthusiasm for at least the Chinese equity markets. Shanghai is currently lower by about 0.4%. That's pretty much the sentiment across the board when it comes to the Asia markets. The GIFT Nifty as well is indicating at best a very, very quiet start with a little bit of negative bias, so much in line with the rest of the globe. But Vinny is here to tell us what the global commentary overnight has been like. Vinny?
Good morning, and a lot of commentary that has come in, obviously continuing to be around the inflation front. And firstly, we have the commentary that has come in from Peter Schiff. Now, he's highlighting in terms of bond yields, oil, as well as gold prices. He believes that this three could furthermore see a higher up move as well and could move upwards as well. And he believes that this is a warning sign that comes in for an investor, obviously in terms of the established inflation that is already there, as well as the loss of confidence that is there in actually in the Fed, as well as the fiscal solvency of the US market as well. So that is something that he is highlighting in terms of concerns that are shaping up, and he believes these three could furthermore move upwards as well. The next commentary we have that is coming from ECB's Robert Holzman, and he's further saying in terms of inflation, he believes that has still not been defeated. There's still a lot of steps that need to be taken to beat that inflation, and he believes that any additional price shocks could further see a bit of an increase in terms of the borrowing cost as well. So that's a concern that Robert is highlighting as well. And then we have a commentary that is coming from Federal Reserve Bank's Richmond President Thomas Birkin, and he's saying in terms of policymakers, he says that they believe they have time to decide whether they should keep the rates stable, or maybe they should look at something like a rate increase furthermore coming in as well. And to achieve that 2% mark, what decision they need to make, he said that they still have time to think about it, but he's still trying to see it, because as of now, when they look at the demand trend is still higher despite the inflation going higher. There's no weakness in demand trend. That indication is not coming in, so that is a factor he's watching out for as well in terms of inflation. How does that move, and how is the pricing going to be moving, as well as interest rate as well. Moving on to the last commentary we have from Oak Capital Management co-founder Howard Marks, who's predicting that there's a sea of change that will favor higher yields over other assets in an era of higher or longer assets as well, and the strategy will need to be very carefully looked at, fundamentally analyzed as well, before any decisions are made.
There you have it, from commentary on bond yields, oil, gold, all of that being addressed by the global commentators. Thanks very much for that, Vinny. All right, let's chat technicals then. And we've got Kunal Bothra as well as Naresh Mirani joining in to give us a snapshot as to what exactly we should be monitoring by way of levels. Morning, Kunal. Let's get in your sense then. Just looking at the print on the index, the fact that we're around the 19,800 mark, the broader markets in tandem with the frontliners, that you're expecting a bit of consolidation around the 19,800 mark?
Good morning, Avan. So yeah, consolidation for the indices, slight bit of uptick is what I would expect. Trying to hold up above that 19,800 levels for the index, but I'm not expecting any major kind of a thrust on the index because of the way many large cap stocks have started to go into consolidations. Not too many large cap names are actually showing any kind of a breakout. Even on the larger cap front, and the performing stocks like L&T, for example, that stock has also been more or less in a range over the last 1 or 2 weeks. And even the large cap heavyweight names like HDFC Bank, Reliance Industries, etc., these stocks have also been into a trading range for themselves. So I think purely on the weight of these larger cap names, I would expect that the index would remain a bit more sluggish. But the market breadth over the last 3 or 4 days, has been quite vibrant, and I think that's where one could probably be focusing on, given the kind of moves the indices as well as the larger cap stocks are showing.
Okay, so let's talk about those large caps. Naresh, hi, morning. What would it be? Would it be HDFC Bank, Reliance, or today possibly Bajaj Finance that could power up the Nifty?
So overall, we would expect everything to contribute a bit till the time we don't see more clarity. So Reliance Industries could be the one which could be turning around. So that saw some bit of price action in the last 1 hour. So that could be the stock which could head up towards 2,400, 2,450. So out of the heavyweights, it's only Reliance Industries which has started showing signs in the last 2 sessions. So I would expect Reliance to perk up and try to make a move towards 2,450 odd levels. And the rest of the markets could just simply chug along.
Find out what those top recommendations are, given that we're in consolidation mode. Kunal, where is it that you're seeing action when it comes to stocks?
So I'll focus on mid-cap names. The first one is a barn, L&T Finance. That stock yesterday confirmed a breakout of its previous swing resistances. Excellent volumes for the stock in the last couple of days, as well as the indicator action has been also very, very positive for L&T Finance. So would suggest a buy. 150 as a target. Stop loss could be kept at 134. And the second stock would be a buy on ITD Cementation. That's a stock which is actually coming back towards a major support at 50-day moving average. In fact, the stock in the last 3 or 4 months has this odd pattern of coming towards a retracement of its 50-day EMA and then bouncing back and restarting an uptrend, breaking past about the previous high. So I would expect something similar for the stock this time around. 240 as a target. Stop loss at 215.
Right. Naresh, what about your stock strategies?
So focusing on the gas sector, that is where we are seeing oil and gas good momentum. So continue like GAIL India, the stock has been slowly and steadily holding around that 130 mark. The stock is close to a 52-week high and is showing signs of creating a new trend wherein it could be a leader in the large cap space as well. So expecting a target price of 150, stop loss at 127. Second is a buy in Indraprasth Gas Limited, IGL. The stock finally has given a trendline breakout, very range bound for the last few weeks as well as for the last few months. Finally, a breakout seems to be in the making. In the last 2 days, it has seen some follow-up moves as well. Expecting this to make a new fresh 52-week high. A target price of 530 could further go towards 600 as well. Stop loss at 470.
Running us through your top recommendations. All right, let's nail it down to individual stocks then. And Anisha joins in the studios to discuss just that. Anisha, let's begin then with the big boy, Bajaj Finance, in line in terms of numbers. I guess taking heart from the fact that the management commentary as well has been strong.
Yeah, management commentary has been strong, but they're not over-enthusiastic as well. They have not increased their guidance despite the kind of AUM growth that we have seen. So they're sticking to 29 to 31% when it comes to the AUM growth guidance, while the street was expecting that perhaps, they'll be able to up their guidance this time around. That hasn't really panned out. The slight disappointment this quarter was on expected lines pretty much, and that was, of course, the compression that we have seen on NIMs. The NIMs contracted by 15 basis points. But going forward as well, the management is guiding that there could be further compression to the tune of 15 to 20 basis points on account of the delay in terms of the pass-through of the rate hikes that we have seen. The second thing that the street is watching out for is, of course, the ROA guidance, wherein they are saying that they will be able to exit at 5% rate for the year. So FY24 exit rate in terms of return on asset ratio should be around 5%. The asset quality for now continues to be quite steady, but the management is flagging out that they are concerned about the delinquency trends that they are seeing, especially for the ticket sizes, which is less than 50,000. For Bajaj Finance, obviously, we don't have much worry when it comes to the overall asset quality and growth as such, but there's just chinks in the armor, if you must, in terms of the net interest margins as well as these asset quality, issues that the company is raising. But Nikunj, valuation is something which is fairly favorable, and we have seen, divergent moves coming in, views coming in from the brokerages. You have Jefferies, which has gone ahead and increased the target price all the way to 9,470 now. But then there is Macquarie, which still maintains the underperform rating.
See, Nisha, let's look at pure numbers. I mean, from a market standpoint, these numbers are not a big surprise because you already have the sense post the quarterly update that this would be another good quarter from Bajaj Finance. So this may not be a market moving number. The concerns on NPAs, well, they've been raised, they are valid, and they're coming at a time when company is raising capital. But these levels, in the sense also, Bajaj has handled in the past. The question you could ask yourself is that at a time when credit is going so strongly, why is there a concern in terms of slippage? So I think you cannot react to it. You may want to monitor it for next 2 or 3 quarters. Then only you will get a decisive trend. But let's break the stock price here. Let's assume that the stock goes to 9,000 rupees. It's at 8,000. In next 1 year, next 18 months, it appreciates by 10%, which is a fairly commendable number for Bajaj Finance after the recent bout of outperformance. So even at 9,000 rupees, Bajaj Finance would be trading at about 5 times, less than 6 times, which actually is lower than its historical average. So the comfort for Bajaj Finance, I think, is the fact that even the growth is high, even they have raised capital, and the future growth after capital raising is going to be superior than what it has been in the last 3 years. The valuation comfort, I think, is still there. So that in a sense becomes this, halo factor for Bajaj. And what amazes me is that, this is one stock where FIs have not sold down. I mean, you got Reliance, which is suffering because of ETF allocations. HDFC Bank is suffering. HUL has suffered. L&T has now started underperforming. But Bajaj Finance is one of those rare stocks which is owned by foreign institutional investor. And at a time when foreign institutional investors in general they're selling more and they're buying less, they're not selling Bajaj Finance.
Yeah, not selling Bajaj Finance. Of course, it's one of those darlings and favorites of the stock market, investors. So holding on and not throwing in the towel, at least for Bajaj Finance for now. And the valuations, of course, are very attractive. But will it be the case for ICICI Pru? That's the question that you have to ask yourself, because the company has gone ahead and missed the expectations this time around. If you look at the value of new business, that was the big miss coming in this time. It missed the street estimates by a good 7 to 8%, and that's why you have Morgan Stanley, which has actually trimmed their estimates going forward as well, and they have a target price of around 665. But it was not just all bad. Of course, the VNB margins also declined to almost 28.5%. But there were some positives as well, especially in terms of the retail protection growth that we have seen. So that's something that you need to watch out for going forward. Morgan Stanley is saying that the stock performance could be muted in the near term, though downside might be limited owing to stock weakness that we have already seen in the month gone by. They maintain the overweight stance from a 12-month perspective, given that the valuations are attractive and the fundamentals are strong. But Nikunj, they will have to deliver on numbers as well to kind of make sure that they are able to command such valuations.
See, Anisha, there is a fundamental change which is happening in the insurance space. And today, you look at insurance and post those change in terms of the taxation regime, there's a time where you were choosing between a fixed deposit or perhaps an insurance policy because you were getting a tax advantage. And I'm just looking at the report which actually is there from, I think, Jeffries. In their own commentary, ICICI Prudential is maintaining the following. The management has highlighted that ICICI Bank has also slowed sales of annuity products as investors prefer term deposit over over insurance products. So for me, that's a big change in terms of the way how insurance or term insurance is the category which was approached versus how it will be approached. Also, LIC is muscling up. SBI has muscled up. So whatever advantage what ICICI Pru had, technology, reach, communication, brand, now that is getting challenged. So it's not going to be a very easy sector to call and an easy company to call. I know there's a change of guard there, and the ULIP business is very strong, and positive markets will always fire up your ULIP returns. But in general, I think there is a tectonic shift in the way how insurance policies are sold in India. So it's, if you're looking at, let's say, a stock like ICICI Pru, while you can make a case of sasta hai, but I think the company has to deliver, and you'll have to wait for 2 quarters out before you can decisively come out, because has been volatility in the past numbers also.
Okay, the list doesn't end here. Anisha, thanks for that. But after a soft Q1, second quarter also was largely in line for L&T Technologies. The margins have been a beat despite wage hikes, but the management cut their guidance for FY24 and pointed to a softer third quarter. Not just that, you have Tata Elxsi as well, which has seen a slight beat in the second quarter with good margin performance despite headwinds. In fact, as we slip into a break, let's listen into what the managements of both these companies had to say post their earnings.
While growth momentum has continued, the pace has been slow on account of decision-making delays and some stress in the sub-billion customer set. We continue to see growth in IP, which will be driven by digital products and digital manufacturing. In telecom and high-tech, we grew by 2% sequentially despite challenges in the Semcon and consumer electronics portfolios. In semiconductors, we are engaging more on the new age chipsets that are designed for AI and cloud computing workloads, which has allowed us to keep growing despite the challenges.
Maintain our aspiration to be at 17% EBIT levels in FY24 and to get back to 18% EBIT levels by H1 FY26.
Now the international deals are being won. There's being some of the smart world resources are being used. We call NGC resources are being used, are being leveraged for that. There is work that is happening in India where we are leveraging some of the LTTS heritage resources as well. So it's now become one team. So we are guiding at this stage 17.5 to 18.5 and comfortable with the upper part of the spectrum.
We have a very small exposure to the semiconductor side of the comms vertical. A lot of our communications business is driven through either operators, or telecommunication, providers, or the folks who make devices that go into the telecom market, right? So these are the main, focus area for us. We have been able to close the deal in our favor, and it's a multi-year deal and a multi-million-dollar, a large deal in our perspective. So which will definitely add to our automotive revenues in the subsequent quarters. So and more importantly, it's in the software-defined vehicle area, which is where we have also been investing significantly.
Thanks for staying on with us. Let's connect with Sanjeev Bhasin, who's joining in on the show with his top recommendations. Sanjeev, thanks so much for taking time out. Let's begin then by talking about the big earnings today. And in particular, you've got Auto that's going to be in the spotlight. What's the expectation from Bajaj Auto?
Yeah, good morning, Avan. I think Bajaj Auto numbers will be very stellar. We know that they are the largest exporter of two-wheelers, and that will be a very, very big icing because of the weakness of the rupee. Their two-wheeler market, particularly on the new launches, is seen a huge demand. And the conversion of EVs from their scooter side is seeing blockbuster demand. So I think Bajaj Auto, by the way, is at new highs, and I think it is headed higher. As a disclosure, we covered this stock much lower, And we still think in the two-wheeler space, this is going to be a huge outperformer, particularly because rural incomes have just started to pick up. Festive season is on the demand, and they have a very good portfolio which suits each budget. So Bajaj Auto numbers can be very sweet. Market may discount it because the run-up in the stock has already been there, but declines towards 5,000 would be a buying opportunity.
Declines below 5,000 is going to be a buy opportunity. What's your view then on some of those PSUs? Because it's an interesting data as well that we've gotten in the fact that you do have the PSU, stocks that have been in focus with respect to the government divestment plans, the likes of Punjab and Sindh Bank, LIC, IOB, UCO, etc. Some of the PSUs with the highest government holding. And of course, within the defense space, the likes of an ITI, Ircon, rail stocks, etc. have been phenomenal movers this year.
Correct. And, Avan, it's the underdogs which were doing nothing for the last 7-8 years, in the last 2 years have been the biggest outperformers. And because of the low, float, or the mutual funds and foreigners having less exposure, they have actually underperformed their benchmarks because of not holding those stocks. So who thought Coal India would be such a big outperformer? Similar is the case with a lot of the other stocks. I'll give you one name. For 10 years, for 7-8 years, fertilizer and chemical Travancore was available between 35 and 50. It had a very sweet dividend yield. But can you believe in the last 1 year, it is up to 700 rupees. I mean, it's just the sheer holding of some of the PSUs, which were always in monopoly businesses, and now the unfolding is happening, has been humongous. And I think that this is just the start, because we know that the under ownership pattern means that there will be a constant up and down, but any decline will be a buying opportunity. Secondly, Aman, remember that government, yes, will encash some part of it because they are seeing huge premium on what their holding is, and they can, reduce their deficit for whatever. But given the impact of the government balance sheets, I think GST collection, the current account, all is being boding well. So I would say you have to be selective here because a large part of the run-up has taken place, particularly in defense and railways. But like I said, the CPSE ETF is a very good exposure. It has 12 of the blue chip stocks. Try and buy that, the CPSE ETF on the for the PSUs.
All right. In fact, speaking of those PSUs, the government is looking to divest stake of up to 7% in HUDCO via the OFS and is likely to raise around 1,100 crores. But what about some of the other PSUs where the government has divested its stake, and which are the stocks that have seen a run-up in the year 2023? Let's get in Somit with all the details and highlights. Somit?
Well, the HUDCO OFS opens today, but the important part here is that the floor price for the OFS is nearly at a 12% discount to the current market price. Now, with this OFS beginning today, all the PSU stocks would remain in focus. Also, given the fact that Nifty PSA index has run up nearly 40% on a YTD basis, making its best yearly gains at least since 2009. Now, so far in FY24, there have been 3 OFS done by the government. Firstly was Coal India, where they have sold around a stake worth around 4,200. Then there was RVNL and SGVN, where they sold a stake worth around 1,300 to 1,400 crore rupees. And HUDCO will be the 4th OFS done by the government. Now, apart from this, which are the other government companies in which are the other PSUs in which government holding is the highest? Now, KIOCL tops the list with around 99% government stake, and on a year-to-date basis, if you see, the share prices of KIOCL have largely doubled. Then there is Punjab and Sindh Bank, which has gained nearly 29%, and government owns nearly 98% stake in the same. LIC government owns around 96.5% stake, but the share prices of LIC have declined around 5%. In Indian Overseas Bank, they own close to 96% stake, and that has gained around 38% on a YTD basis. And lastly, in UCO Bank, they own around 95.4% stake, which has gained nearly 31% in 2023 so far. But which are those PSUs and which have gained the most, and how much does government own in them? Now, ITI is the PSU that has gained the most in 2023 with around 206% of gains. Then there is Mazgaon Dock, which has gained nearly 171%. Ircon International, which has gained nearly 167%. Then there is REC and IRFC, which have gained in the range of around 130 to 152%. Now, in REC, the government holding is the lowest at around 52.6%. But in other companies like ITI, Mazgaon Dock, Ircon International and IRFC, government holding ranges anywhere between 73 to 90%. currently. So keep an eye out for PSUs in stake. PSUs in would continue to remain in focus.
It's PSUs, and we've just heard Sanjeev Bhasin's take on that as well. The other one, of course, which the street is going to begin the day reacting to is, like we just flagged off, Bajaj Finance's numbers. And the numbers, while they're largely in line, both on the NI, the PPOP, or for that matter, the PAT, there's still, Sanjeev, valuation comfort as opposed to its historical averages for Bajaj Finance. Given the leader that it is, I mean, yes, there is a little bit of NPA pressure, but you think the valuation comfort will see the stock through further from here?
Yeah, good morning. Aisha, I'll give you a small, playback. In January, February, when the Adani crisis broke out, Bajaj came out with a slightly weaker guidance, not numbers. And the stock got thrashed from 7,600 to 7,300 in no time. It's the problem of over ownership of FIs. Now they come out with the best of numbers and the stock seems expensive. But let me tell you, it's been a pedigree stock. We've already read from what Rajiv Jain says that we don't want to overstretch ourselves in smaller cities and smaller lenders where already there are 2, 2, 3, 3 loans going. So they are very, very selective in their, dispersals. But it is also telling you that they are ready to raise capital, which means the next 6 months actually before the election and budget could be the best for spending. So always Bajaj Finance, Bajaj Finserv have always been expensive stocks, but they've always delivered, ahead of what the street looks like. So I think I cannot comment on it because we own it, but I think that any decline would be, it's a pedigree stock to own, just like an HDFC or a Reliance.
Kunal, 8093, good level to buy or add positions?
Yeah, it's a good level to buy Bajaj Finance. Even Bajaj Finserv, I think that stock has been an underperformer of sorts. I think there is a difference in terms of trends of almost 10% or 12% between Bajaj Finance, the positioning of the stock with respect to where Bajaj Finserv is, with respect to its relative previous swing highs or major highs for itself. So I would be of the belief that Bajaj Finance could be a good buy even at current levels. The stock has hardly shown any major periods of volatility and even a very sharp phase of a correction. I think that was seen somewhere in 2022, mid part, as well as prior to that. So, it's very rare that you get such kind of a sharp phase of a 10%, 15% swing into the stock on the downside. So, I think it's a good level to buy the stock.
Okay. One of the biggest Nifty, or rather liquid universe F&O movers yesterday was Canfin Homes. A 4% move coming in on Canfin yesterday reacted to its earnings. The net profits, remember, rose about 12% to 158 crore rupees. And the NII as well saw an uptick of about nearly 26% in trade. So that really went well with the street. And this is at best a beat as opposed to what the street was penciling in. Naresh, come in on the charts first after that big move you had on Canfin and whether we can see a follow through or not.
So, post the numbers, if it can sustain above that, closer to this 780 mark, that would be a confirmation of a breakout. The stock has been sideways for the last 3 months, ranged between 730 to 800. Yesterday was good volumes, and today post numbers, if it sees price action above 780 would be positive. Overall, even at current level, 750 is a stop loss. So technically, sideways consolidation done for the last 3 months could see an uptick towards 850 also.
Sanjeev, so far in the earnings, we've only seen big disappointments coming from IT, and that too was much along expected lines, largely in the price. But do you sense we could see some howlers this earnings season, or do you think at large we'll be in line this Q2?
So Aisha, there are two positives. One, this even with the geopolitical risk and some of the profit taking because of high yields, the FI selling seems to have exhausted itself. Two, I think the destination India as a capital market and for inflows becomes very, very attractive in the next 6 months. Three, I think consumption and the way spending patterns are churning. And if you see the large caps which are raising capital because they foresee growth, then I think earnings can be, much better than what we expect in the coming Q quarters. There will be sectoral churns because of higher crude, but it could add as an advantage and disadvantage both depending on the sector. So I think that definitely some of the banks can be very, very strong on the earnings. and particularly the large caps like ICICI Axis. I would also think that auto numbers will be maybe ahead of the street, and I would be locking out for Maruti because that has been a very, very strong performer. On the other hand, cement numbers again will be very, very sweet, and the further guidance because of a raise in prices will be again much on the anvil. So selective numbers, and like you said, IT, maybe the deliverance has been reasonable, but the guidance will always be little conservative, as you are aware of higher yields and the geopolitical risk which exists for the time being. But selective outperformance will be there very much on the cards in select stocks, pockets and stocks, particularly the PSUs.
Okay, that's the take coming in on the overall earnings season and what color we may actually see. In fact, talking about autos, even yesterday you had the likes of a Bajaj Auto hold out well. We've seen the performance that a TVS Motors within the two-wheeler pack in any case has given year to date, or for that matter as compared to its peers. And yesterday you had Bajaj Auto as well scale up ahead of its numbers today. Sanjeev, just talking about the two-wheeler space, what's the anticipation on what the earnings could throw up?
Well, like I said, there has been almost 18 months of underperformance of two-wheelers for whatever reasons, higher rates, higher inflation, and the global scenario where rural incomes didn't pick up. But look at the change in scenario. Hero Moto is actually guiding on the upside on volume and margins. Bajaj Auto is anyway taking the cake. And we know that Eicher has been a very, very steady performer. And look at TVS, it takes your breath away. So I think definitely this space is a very, very sweet spot. And the coming 6 months will actually bode even better, because government spending, rural initiatives all add up to rural incomes where the aspiration on two-wheelers is very, very high. I would also add, in the four-wheeler space along with Tata Motor, you can see that Maruti is issued the highest number of shares at the highest premium at 10,400 to its promoter. And now you have Ashok Leyland, which actually is a dark horse for me, which can actually supersede earnings on all three counts. Their passenger vehicle, their buses, they are the third largest bus maker in the world, with having 53% market share in India, and three, their internal small supplier which they have, which is growing called DOS, which is growing very popularly in the rural areas.
Sanjeev, good to have you on board. Thanks as always for joining in with your stock ideas and recommendations. To stocks on the editor's radar, and today we've got large cap, private bank, Kotak Bank in the spotlight. Jefferies bullish, buy with a 2,400 rupee target price.
See, yesterday it was HDFC Bank, last week it was IndusInd Bank, and now we have Kotak Mahindra Bank. You would say, okay, it's old wine in the same bottle. But sometimes the story has to be told when the story is good. And I think that's the story, which you want to bring out with a stock like Kotak Mahindra Bank. Now, it's very simple. Markets are worried about the migration after Mr. Kotak's exit. That's a valid concern. That is one of the big reasons why, let's say, HDFC Bank has also underperformed, and that in a sense had also hit ICICI Bank. But is the margin of the safety now telling you that whatever the migration or whatever the transition concerns are they in the price? And that's where I want to go back to. This entire view from Jefferies, I would like to endorse it by simply saying that whatever they are saying right now in terms of the transition issue, that is something I think it is quite valid. B, I always look at valuations. Whatever may be the situation, but what is the buying price? What is the margin of safety? What is in the price? And for me, that I think this graph tells you the real neat, nice story. Kotak Mahindra Bank, now the yellow bar is LNFS. This is pre-COVID, and now it is post-COVID. Okay, has the shape of the economy post-COVID become better or worse? Avan, let's understand.
Better. It's
become better. So what should happen to banks which have a supreme asset quality and which have a supreme NPA trajectory? They should be trading at a premium to where they were.
Yeah.
They're trading at a discount.
Yeah.
Look at the current valuation. Similarly, for ICICI Bank, it's the reverse which has happened. And for HDFC Bank, it's actually the reverse. I think the reason why these valuations, the stocks have come down is because they were overowned. Everybody had invested in them. FIs have sold out. And suddenly the rest of the financial space was looking much more attractive. But I think it's now time to go back to basics and say that, okay, where is the margin of safety in this market in financials? I think it still lies with large cap stocks. And the price is just so... the margin of safety is just so attractive that the risk if you invest in some of these large banks now, especially Kotak and HDFC Bank, I think is on your side.
Okay, there you have it. That's interesting analysis there, Aisha, on Kotak Bank and some of these other private banks when it comes to valuations.
Oh, yes, absolutely. In fact, let's pick up on that conversation forward with Dipan Mehta. He joins in on the show right now. Dipan, hi, morning. Good to have you on the show as always. You think it's going to be a battle out there when it comes to private banks, or do you think the current leader, ICICI Bank, will win?
Good morning and thank you for having me on your show. It's always been a pleasure. See, I think it's just that the private sector banks, I think even ICICI Bank will join that list of at performance or underperforming banks like HDFC and Kotak. And the reason for that is that there's a lot of excitement around the smaller banks, the PSU banks, where valuations are lower and growth rates are higher. I think we are getting into that phenomena where a lot of smaller banks will grow much faster. And investors are therefore shifting their allocation within the portfolio from the larger banks, the ones which have delivered exceptional returns, to the smaller ones, to the PSU bank, because that's where I think the risk return profile is better. They may not be the best banks, of course, looking at the past track record, but they are the best investment stocks at this point of time. And I think that's what's happening. And this will continue, I think, till we see some sort of a shakeout within the banking sector or the NPA cycle starts to pick up, which is when the smaller banks will feel the pain far more than the larger banks. So that's my assessment. But I'm not selling ICICI, HDFC Bank or Kotak Bank. I'm just remaining invested. Most investors like me have been in it for many, many years, if not decades. And we're sitting on huge profits. And I think next 3-4 years also, there'll be secular growth compounders. So just a matter of time before they start to, deliver returns which are at least in line with Sensex and Nifty.
Right. Dipan, so let's extend that list. Curious to know if there are any other smaller banks that you've added to the portfolios or recommend doing so.
No, I think I've spoken many times about IDFC First Bank, and recently I think the CCI has cleared the merger of IDFC and IDFC First Bank. Not that it's a major event, but it's one process that will be over and done with, and it should result in improved capital adequacy for the bank as well. And apart from that, I think we are seeing very good numbers coming through from Federal Bank. I was very impressed with the numbers which came through. Another company which we and our clients are invested in. I think they're firing on almost all cylinders, and NPAs are very well under control. And I think one of the banks which is investing a lot in technology as well. So I think down the line also you'll find a lot of PSU banks. I thought Bank of Maharashtra came with good set of numbers, and same trend will be seen in some of the other PSU banks, especially the smaller ones like say Union Bank or UCO Bank, maybe even Bank of Baroda, Bank of India as well. So that's why I think that where we are focused on. And as I said, I think these are the banks which I think will outperform for some more time.
Okay. So, Dipan, I have a simple question. It's not that HDFC Bank and Kotak are not growing. They are growing. But their valuations have come down to levels which are pre-COVID, which are actually lower than pre-COVID and pre-LNFS. Is it just a phase of the market where the over ownership now has to get checked, and it's a matter of maybe a cycle, a bad patch, and they will regain their mojo? Or there is something fundamentally different in the way how one should approach financials now?
Well, I think it's just a phase. And while we are seeing a lot of money coming into mid-cap funds and mid-cap stocks directly by investors, we are going to see an oversized price movement in the small mid-cap banks per se, because that's where I think they are focused on. The minute we start seeing solid FII flows, that's when you will see HDFC, ICICI and the like start to do much, much better. But as I said, I think it's just that there's only so much that you can allocate to banks. And there are just so many banks which are now doing exceptionally well. So investor attention, investor allocation is shifting away from the top 3-4 banks to some of the other smaller banks. There was a time, I think, if you go back to 2018, 19, and even 20, right through COVID, the larger banks like HDFC, ICICI, Axis Bank, they had their NPAs well under control. And mind you, Nikunj, the most important parameter, the data point to invest in the bank is the NPAs. And these top 4-5 banks had done exceptionally well on the NPA front, which is why they were the favorites of investors. But now I think you look around a whole host of other smaller banks, including PSU banks, have net NPAs which are equivalent or slightly better than the likes of the top 4 or 5 banks. So that's providing investor comfort, and certainly they are cheaper price to earnings, price to book compared to these banks even as of now. And growth rates are in line or slightly better. So, and also liquidity is coming in over there. So that's what explains the interest in the smaller banks as compared to the top 4 or 5 private sector banks. But that can easily turn once you feel that there is a heightened competition within the banking sector and net interest margins are under squeeze, or the NPA cycle turns, because these larger banks have a far superior quality of balance sheet. They have a better deposit franchise, better brand, better technology platform. And that's when I think, when the times are tough in the banking industry, that is when I think investors will go back to the safety of these top 4 or 5 private sector banks.
Okay, lot of earnings, and today you've got Wipro as well as LTI Mindtree, and remember LTI Mindtree is a nifty company as well. So let's take it across to Anisha and find out what to expect, and could we expect anything better than what TCS and Infy have done, Anisha?
Doesn't look like. I don't expect any big improvement coming in numbers of LTI, Mindtree as well as Wipro, because both these companies had reported a soft Q1. Over that, let's see how they perform, because at least for LTI, Mindtree, we're working with a growth of around 1.4 to 1.5% in terms of constant currency and dollar terms. Rupee revenue might accelerate a bit more, so 1.9% kind of growth is what we are penciling in. Growth would be led by their manufacturing vertical. We have seen good growth coming in high tech as well, but that might be moderated by the kind of performance that we have seen in the BFSI vertical, because for the last couple of quarters that has been a bit soft for LTI Mindtree. Margins might contract by almost 100 to 150 basis points on account of the wage hike impact, and that's the reason the profitability might also be down 3%. The other thing to watch out for is deal wins. There also we are expecting a bit of moderation in Q2 for LTI Mindtree versus the performance that we had seen in Q1. In terms of monitorables, the management had already guided that double-digit growth in FY24 is a tall ask. So if not that, maybe in FY25 is it possible or not, and whether they hold on to their margin guidance of exit rate of 17 to 18% for FY24 will be critical. Quickly moving on to Wipro as well. Last couple of quarters have been very dismal, both in terms of the revenue performance as well as the headcount trend that we have seen, as it is the guidance that they had given for Q2 factored in a decline of 2% and all the way a growth of around 1%. For now, the street is expecting that the performance will be towards the lower end of the range. So we are expecting a cut of almost 1% when it comes to the constant currency as well as the IT service revenue is concerned. Margins might hold up okay at 16.2% because there has been some delay in the wage hikes which the company has pushed to Q3. Profitability will be close to around 2,800 crores. The big thing to watch out for Wipro will be the Q3 guidance. There also the street is very divided. The range goes right from a cut of 1.5% all the way to growth of around 2%. So let's see what the company actually delivers, because for now the performance has been rather weak, and hence of course the valuation discount that Wipro gets.
Okay. The valuation discount what Wipro gets, I mean, it's one of the stocks which frankly is on no one's radar right now. We can look at IT companies and say, okay, nothing is happening. But if I look at the deal pipeline, what has been communicated by a HCL Tech or a TCS or a Infosys, you know that orders are coming. So it is one of is large cap IT one sector where you say 6 months don't expect anything, but next 12 months you should expect something big.
Yeah, I think so. But don't expect major fireworks if they're going at 4 to 7% or thereabout, or depending on which what company says, they start to grow at low double digit per se. And unless you don't see the US economy, global economy on full throttle and in a kind of a bullish phase in terms of overall economic trends as well as tech spending, I don't think these companies can go back to that 17-18% type of growth rates which typically investors look for when they are evaluating an investment. But the action is going to be more and more in mid-cap stocks, small-cap stocks. And that's where I think investors should focus on. Smaller companies, lower base, it's easier for them to continue to grow at that 15 to 25% type of top-line growth rates. And that's what I think, meets the benchmark of many investors, because that's where the compounding comes into play. Also, I think that after almost, I would say I've been tracking this industry for 2.5 decades. I feel that mid-cap companies are able to create a niche for themselves. They've been able to compete with the large-cap IT companies. They are bringing a lot more value to the customer. Customers have recognized their certain skill sets and certain domain knowledge, which is why I think they're getting a good flow of orders as well. So I would, even if things do start to improve in the US market and globally, I would still like to continue to place my bets with the mid-cap IT stocks, especially the ones which are focused on niche segments where they have created a very solid, I would say, expertise, which is valued by the customer and now I think by the street as well.
Okay, let's also find out what are some of the technical charts of the buzzers in yesterday's trading session indicating. And Nuresh, wanted to get in a take from you on the charts. SIAT, if you've had a look at it, as well as something like an IRCON International, that's been awfully volatile and wrapped up yesterday at 160.
So SIAT saw result reaction, opened up with a big gap, did not sustain all through the day. It drifted lower. So that's an indication that the market is not ready to accept the results in a positive sense, even though the numbers were better than expected. So for now, that indicates we are going sideways. Unless and until we cross the highs of yesterday, the stock could get into a new range, which is basically 2000 to 2350. So technically, not looking interesting as such. So would expect a sideways drift to continue. IRCON, that's a stock which has seen a lot of volumes yesterday as well as a day before. The trend has been positive right from the time it broke out in the 60s. The previous high for the stock is 170.75, which would be tough to cross. So I would expect some bit of, say, consolidation here again, but with a higher range. So time to take some profits off on IRCON, not a buy at current levels.
Okay. What's the view then, Dipan, on Zomato? If I recollect, it was one of the stocks within New Age Tech that you were bullish on. Just today, we've got a positive brokerage note. They're talking about World Cup trends, ad spends picking up, and all of that is going to work in favor of a Zomato. Your views?
No, I think nothing has changed. We remain very positive on Zomato. And I gather that even the quick commerce division, the Blinkit, which they acquired, that also is showing very good growth rates and expanding in a sensible manner. And my sense is that you could expect some positive news from that particular division, which has been a drag in the upcoming results as well. I think the food delivery business is kind of, just growing steadily. And at some point of time, maybe 8-10 quarters down the line, it will be a solid contribution to the profitability of the company. And I think that as an investment, as a company, it's shaping up really well. And a lot of the doubts that investors had about when it would break even and when it would start reporting positive earnings per share, those are being gradually addressed. And I think that valuations also are pretty decent if you extend it into, say, 3-4 years down the line, and then expect the company will grow at 15-20% or thereabout. I think you have a winner on your hands. Again, a disclosure, we and our clients are invested, so please do your due diligence before buying into the company. It's not a recommendation.
What is your target price for Zomato? I mean, you have to be mindful of that as well, because now it's a market cap of about $10-12 billion, almost 80-90 lakh crore. So how do you say that this is the right price and this is what could be the potential of Zomato? Because it's no longer like a tiny toon. It's no longer a $5 billion company. It's almost like a 90,000 crore market cap now.
Nikunj, I've been asked this question many times on many stocks, and I always said that I don't have price targets, I have growth targets. And I will remain invested in Zomato so long as they're able to grow at above 30% top line, period. I think that's my benchmark. If they can continue to grow at 30% top line for 3 years, 4 years, 5 years, 10 years, then it will be a multi-bagger. I'm pretty certain about that. So I don't want to keep any price targets, because when you keep a price target, you may sell at that price target and the company continues to grow and deliver exceptional returns after that. So in my opinion, price targets are meaningless. If the company does everything sensibly, has a decent capital allocation policy, and there's inorganic growth like Zomato of 35% or thereabout, remain invested. I think at some point of time you'll be handsomely rewarded.
So can you give me an example, Dipan, where you've said that, look, I bought the stock, it was expensive when I bought it, I ignored what brokerage is and what the conventional wisdom was, and my conviction was rewarded. I just want to bring this point out for our viewers, because, I mean, it's easy to buy a stock, but it's difficult to really not sell the stock. The temptation to sell a stock when it goes up 10%, 15%, I think is very high, and I respect that. But big money, viewers, is always made when you buy a good company and you just sweat it out and then you hold it. So can you give us an example, Dipin, like what has really worked for you in your real life?
So I'll tell you what has not worked and what we missed. One is Trent. I think it's a phenomenal story, and it's been a multi-bagger. And any point of time when you entered the market, it was expensive. It was never ever a cheap stock. I mean, it was always 35, 40 times, and still it has done exceptionally well for the last 10 years or so. One company which did work out for me was Tata Elxsi. It was always the most expensive IT stock even 5 years, 10 years, 15 years ago, if you go back. And yet it's been like a 40, 50 multi-bagger. So these two companies come to mind. Third is PI Industries. In 10 years ago also, it was trading at premium valuations compared to UFOS and some of the other agrochemical companies. And that's also been a fantastic multi-bagger. So I think valuations, I don't even remember what P multiple I bought these companies at, 4 or 5 years ago, or even, 10 years ago. So I don't remember also, but I knew that they were good quality companies. And I don't think I paid, a cheap P multiple for them. And yet they continue to grow. And, when companies are in growth phase, investors tend to pay a much higher P multiple. So you'll be surprised that a stock you bought at 25, 30 times P multiple, 5 years, 7 years down the line, that the growth rates are sustainable, the business model becomes even better, and there are higher barriers to entry. Suddenly the P multiple goes from 25, 30 to even 60, 70 or so. So I think these things I've seen in the past, and the important thing is to buy good quality business and hope and pray that they can keep on growing at that 20-25% type of growth rates for extended period of time. And that's when you have a solid multi-bag on your hands.
To real estate, did you miss the bus? What is it that you hold within this space? Because in the last month or so, there's been a pretty fiery rally that's taken place.
No, I think we were very early into Godrej Properties, and in a way, Godrej Properties has underperformed some of the other larger or even mid-size real estate companies. But this is like a 4 or 5 year cycle, very positive on it. What I appreciate the best is that all the large listed companies are, acting in a very responsible manner, focusing on sales, focusing on quality of balance sheet, not overextending themselves. The last time investors got very badly hurt in the real estate cycle because these companies just went after land bank, and that kind of messed up the balance sheet. But this time around, it is all about new projects, immediately trying to sell the new projects. The regulatory framework is far better from the organized real estate players' point of view and from the customer point of view. And even if you felt that presently these companies are pretty well, I would say, valued in line with their net asset value, every now and then they are getting new projects. I think you keep an eye on the newspaper, whether it's a Shobha or a Macrotech or a DLF, they are doing some new project, redevelopment project, or acquiring some land bank, or doing a JV with a smaller player. So they are also continuously increasing their net asset value and their land bank and the kind of potential square feet that they can deliver over the next 3 to 5 years or so. So these are great times for these companies, and all of the balance sheets are fantastic. In terms of corporate governance also, which was one of the biggest fears in real estate, I think that also is gradually coming down because of RERA and all the places, and increased scrutiny by the regulator and by the market and by the government. So I think these are absolute blue sky scenarios for real estate companies.
Good to know. That's the view coming in on the real estate space. But let's shift gears to auto then. And Tata Motors in the spotlight. They've given a facelift to the Safari and the Harrier SUV to compete with other SUVs. The ex-showroom price of the facelift variant of Harrier SUV is between 15.4 to 24.4 lakhs. Excuse me. And Safari SUV has been priced between 16 lakhs to 25.4 lakh rupees. 18 hours, Sumit Chaturvedi caught up with the Tata Motors Managing Director for Passenger and Electric Vehicle Division, Sailesh Chandra, to know more about the strategy for the SUV business. Listen in.
I mean, the Harrier Safari had been a very popular model. Harrier was introduced in 2019, and then Safari followed it with 2021 launch in its new avatar. We have seen in the last 2-3 years that there are very distinct customers for Harrier and Safari. Safari is for those people who have achieved success, they have a very busy lifestyle, but also they want to reclaim their life by spending time, quality time with their family and friends, and therefore a 7-seating configuration works well. Whereas in Harrier, you see more young achievers, who are modern day, warrior kind of a mindset. And therefore it was appealing to slightly different customer segment. And therefore we thought that we need to give distinctness to these two products. And that has gone behind the idea of giving a massive upgrade. While we saw that we had to give styling differences and bring that greater SUV kind of styling and more modern styling, we said that we will also upgrade this to the next level as far as technology is concerned, comfort is concerned, and more importantly, safety. So this is the safest car on road.
Okay. Now we were debating yesterday that if you look at the 2-year change, the real two massive outperformers, Tata Motors and TVS, they both have one interplay, which is EV. Then you look at smaller companies which have a EV interplay. You could talk about Atul Auto. Then you can talk about some of the P companies, some of the auto ancillary companies like Sona, Koyo and others. Exide, which is planning to move into EV batteries. Amara Raja has already moved into this EV battery. So this entire ecosystem in a sense has seen a massive re-rating in last 2 years. But EV is growing. But cars also have the ICE engine, and ICE engines still account for more than 80-85% of the total sales. So in last 2 years, Maruti has done precious little in terms of price performance because they've not moved into EV. So my question, Dipen, is that should we flip now? Last 2 years, Tata Motors and TVS have done well. Next 2 years, do you think it could be the classics, Hero and Maruti, which could make a comeback?
See, Nikunj, I'm not positive on the two-wheeler segment, especially the commuter segment, because the competition remains intense over there. And in a way, I think the market is gradually getting saturated. They can never go back to that, I would say, solid double-digit type of volume growth rate. And they're not getting adequate benefit of the premiumization which is taking place within the auto industry. I just want to explain over here that this premiumization is a very powerful trend within the auto industry, because the average selling price keeps on increasing for select companies like, say, a Maruti or even a M&M, to an extent even Tata Motors, within the two-wheeler space for a company like Eicher Motors, because the average consumer is going for pricier cars or pricier two-wheelers, and it's just a marginal increase in the EMI, and that's what's driving this particular trend. These days, they want cars with all the bells and whistles, and that's where also the maximum profit margins are there for all the auto companies. So from that point of view, I think Maruti remains our favorite in terms of a premiumization trend taking place over there. And it's only a matter of time before Maruti starts to have, I would say, starts to unveil its electric models as well. And they have committed 2027 as the time when they would have a lot of electric models as well. So I would still stick to Maruti. The problem with Tata Motors is that it's got JLR, and JLR is a big, it's a giant over there, and its profitability keeps on fluctuating. Sometimes it's Europe, sometimes it's UK, China. Something does well, something does badly. And there's no real, I would say, handle on what the projections could be for Tata Motors. But Maruti, on the other hand, M&M also to an extent, there's a fair degree of visibility for next 2-3 years or so. And despite the interest rates, the way where they are, we are seeing a very good volume growth coming through in the passenger vehicle segment, and that's very positive. So I would go with the traditional companies as well. And Tata Motors also in a way is a traditional company, just that it has got a more exciting EV strategy. But it's a matter of time before M&M and Maruti also are on the same league.
All right, good to have you. Thanks so much, Dipan, for taking time out and chatting with us about your market outlook. All right, what's going on with the pre-open rates then? And for now, it's a little bit quiet, but holding on to the 19,800 mark for the Nifty, and that's the Sensex for you, up about 30 points. Let's find out those mid-cap strategies. What is it that our chartists are betting on within the broader universe? Kunal, let's get in your top bet.
I'll go with the bounce CESC, the stock which is forming a bullish flag pattern on the daily charts, heading towards a breakout above levels of 92 odd for the stock on the spot level. So would suggest a buy with 100 as a target and stop loss at 88.
Okay, Naresh, what about your mid-cap strategies?
So that would be a buy on Sun TV. The stock has broken out of a multi-year high. above the 2019-2021 highs and sustaining well for the last 3 sessions. Out of derivative band today, you could see some price action towards 700, stop loss at 630.
All right, there you have it. Those are your top mid-cap strategies. Moving on, here are some other top headlines then to track across the globe. 12 days on, but there's no signs of a ceasefire between Israel and Hamas. In the latest airstrike on a hospital in Gaza that left 500 dead, while hundreds of others have been injured. Many are still believed to be trapped under the debris as the search and the rescue operations continue. While both Israel and Hamas continue to blame each other for the strike, the death toll on both sides has crossed over 4,600. Meanwhile, in a major boost for Israel, the US President Biden is visiting Tel Aviv to meet the Israeli Prime Minister. However, in what can only be seen as a snub to the US, the president of the Arab leaders has called off the meeting with Biden, citing suffering Palestinians amid Israel's offensive. Biden, remember, planned to travel to Amman to meet the leaders of Jordan, Egypt and Palestine following his Israel visit. Meantime, the fifth flight carrying 286 passengers, which included 18 Nepalese nationals, landed in Delhi from Tel Aviv on Tuesday as part of the rescue Operation Ajay. The aircraft that was scheduled to arrive in Delhi on Monday faced a technical glitch upon reaching Tel Aviv on Sunday, and it was taken to Jordan to fix the problem.
And moving focus to the business world now, chipmaker stocks took a beating on Wall Street overnight on the back of fresh curbs on exports of AI chips to China. The new export curbs are a step up from the earlier ones that the Biden administration had implemented last year. Remember, stocks of Nvidia, Broadcom saw steep cuts overnight, and the new curbs banned the sale of the slowed down version of Nvidia. And closer home, some good news for Delhiites finally. Delhi's air quality has seen a remarkable turnaround, shifting from poor to satisfactory category. The improvement has reignited hopes of the capital city for the government as well. Delhi air quality especially tends to worsen during the winter season, remember, or the onset of winters, because of the rampant stubble burning in the neighboring states. Although one can say that it's actually Mumbai which is overtaking Delhi in the air quality right now. It's quite poor. But Netherlands registered a stunning 38-run victory over mighty South Africa in the second major upset of the 2023 ICC Men's World Cup. Notably, this is only a third win in the history of the ODI World Cup. Skipper Scott Edwards led from the front with an unbeaten 78 as the Netherlands posted 245 runs in a 43-match over.
So Kunal, it's cricket also small cap. So Kunal, it's cricket also small caps are coming back, right?
Well put.
It's not. Yeah. I mean, just think about it. Small caps are the season.
Yes.
I saw the Afghanistan match with my son, and we saw the score. No, it just said you channel surfing. You know, it was a family day, and I just thought, okay, maybe that's the score for England, not Afghanistan. And then I realized, oh my God, it's actually the other way around. Yesterday also the same thing happened. You flipping channels, you know, just before you just having some family time. And I said, okay, lagta hai ye Netherlands ka score hai, South Africa. Then I realized it's the other way around. So we should not complain about small caps.
Yeah, they were 50 for 4 in the first, I think, 8-10 overs. And from there, they made 245.
Wow. And I did another Google because I've never read a headline which says Delhi air quality improves. Yeah. That's never happened, right?
That is a headline.
And now there's zero visibility in Mumbai, as you were saying, pretty bad.
Yeah, I mean, I think the ceiling gives you a clear picture of how bad it is.
It's like a moment in time we should capture and say a headline which actually was read on ET Now by Aisha Faridi, which says that air quality in Delhi has improved. They've done nothing
Mumbai
new.
Is bad.
Yeah. By the way, they've done nothing new. It's not that anything has changed in terms of couple, stubble burning.
There's no odd even, nothing, no measures taken in
But
place.
kya hota hai? So just start off winter right now.
Yeah. Okay, on that note, let's get some other khabar as well. Back to markets, and Polycab, it seems, that's the one which is the talking point this morning. And Sharad is here to tell us why this is the buzzing stock.
Well, yes, in focus we are having Polycab, and there's a high probability that the company might be included in the MSCI index inclusion in the month of November. Because of this reason, there has been accumulation coming in from the HNI segments as well as domestic institutions. Now, analysts have stated that the company is still under-owned when it comes to the FIs, and we did check the numbers coming in, and the FIs hold less than 10% stake in the company, to be precise 9.66% stake. Because of this expected inclusion, there is a flows expected coming in, and today itself Polycab is going to report its numbers as well, and the entire market will, of course, apart from the valuations front, they'll be looking at two important segments, and that will be the structural story and the growth of the cable and wire segment that is expected to perform strongly, and also the high margin business, where currently the FMEG segment, the fast moving electrical goods segment if you call it, that segment's performance is also something which the market will be watching out for. Going ahead, what will be the guidance, especially in the revenue contribution from this segment? That will be something which the street will be expecting.
Right, okay, that's Polycab, which is once again in the limelight, but here are some other stocks as well that you need to keep on your radar.
See, yesterday it was HDFC Bank, last week it was IndusInd Bank, and now we have Kotak Mahindra Bank. You would say, okay, it's old wine in the same bottle. But sometimes the story has to be told when the story is good. And I think that's the story, which you want to bring out with a stock like Kotak Mahindra Bank. Now, it's very simple. Markets are worried about the migration after Mr. Kotak's exit. That's a valid concern. That is one of the big reasons why, let's say, HDFC Bank has also underperformed, and that in a sense had also hit ICICI Bank. But is the margin of the safety now telling you that whatever the migration or whatever the transition concerns are they in the price? And that's where I want to go back to. This entire view from Jefferies, I would like to endorse it by simply saying that whatever they are saying right now in terms of the transition issue, that is something I think it is quite valid. B, I always look at valuations. Whatever may be the situation, but what is the buying price? What is the margin of safety? What is in the price? And for me, that I think this graph tells you the real neat, nice story. Kotak Mahindra Bank, now the yellow bar is LNFS. This is pre-COVID, and now it is post-COVID. Okay, has the shape of the economy post-COVID become better or worse? Avan, let's understand.
Better. It's
become better. So what should happen to banks which have a supreme asset quality and which have a supreme NPA trajectory? They should be trading at a premium to where they were.
Yeah.
They're trading at a discount.
Yeah.
Look at the current valuation. Similarly, for ICICI Bank, it's the reverse which has happened. And for HDFC Bank, it's actually the reverse. I think the reason why these valuations, the stocks have come down is because they were overowned. Everybody had invested in them. FIs have sold out. And suddenly the rest of the financial space was looking much more attractive. But I think it's now time to go back to basics and say that, okay, where is the margin of safety in this market in financials? I think it still lies with large cap stocks, and the price is just so, the margin of safety is just so attractive that the risk if you invest in some of these large banks now, especially Kotak and HDFC Bank, I think is on your side. Let's see when markets really latch on to this, logic in terms of sasta hai, bada hai aur sasta hai. Okay, now what do we have? Pre-open rates. In this market, we are at that phase where bad numbers will be punished and good numbers may just be ignored. The exception so far has been IT. But I think even the Bajaj Finance numbers are good. It could be a day of, good news is in the price. The fact that Bajaj Finance is growing, I think it's yesterday's story, not tomorrow's trend. Markets will always react to tomorrow's trend. For IT, there is a hole. And that hole now, I think, could just really become more like a, crater, because none of the IT stocks, in a sense, have really done something special post numbers. It's a big day for numbers because you've got Wipro, LT, Mindtree, Bajaj Auto, and IndusInd Bank. The watch one here really could be IndusInd Bank, purely looking at the last 3 or 4 quarters, what they've delivered and what they've shared with us. Now, first rates will just start coming in. It's Wednesday morning. We are not expecting anything large, or we are not expecting anything big from any of the individual stocks here. So I'm just going to restrict it to the Sensex and the Nifty. And it's a very flat start, both for the Nifty and for the small cap index. Small cap index on a relative basis is doing much better. Let's address the newsmakers here. ICICI Pru, roll it back to what is happening to Bajaj Finance, and then ahead of numbers, Bajaj Auto, Wipro, and also what essentially is a trend. That's Bajaj Auto for you. Nothing big or nothing powerful. Wipro is not doing anything special, and frankly, Bajaj Finance also, it's turning out to be more like a no-go despite encouraging set of numbers. Aisha?
Yeah, just a couple of other names which are going to be in focus as well this morning. And while, that's Bajaj Finance, let's revisit what HDFC Bank is up to. While it did not really tank yesterday, you didn't see any material follow through come in on that stock. And today it's actually squared off all of yesterday's gains. It's again down about 0.6%. So just a one-day respite really is what you saw on HDFC Bank. I can see a sharp gap down on Hoodco after the OFS got announced just last evening. So that's another stock which is in focus as well this morning. Remember, the government is looking to sell about 7% stake via OFS. The offer price has been set at 79 rupees per share. The Scanfin Homes, strong set of numbers. The second quarter NIMs have come in at a six-quarter high of about almost 3.8%, which is clearly above estimates. Yesterday also the stock was a big mover. Tata Elxsi also should be reacting to its numbers. The profits have risen really nearly about 6% on a sequential basis. And then, of course, there's Mazagon Dock as well, which has bagged a defense contract of 310 crore rupees for training ship supply. That stock gaps up 3% higher for Mazagon as we speak right now. There's IRCTC Zomato as well. They've signed an agreement for supply and delivery of pre-ordered meals. IRCTC marginally higher. Zomato is now at 114 rupees per share. There's, Nikunj flagged off ICICI Pru, Bajaj Finance. There's L&T Technologies as well. The results are healthy, but the constant currency revenue growth guidance has been cut, so look out for that. And then, of course, there's Syngene, where the numbers are disappointing. That stock should be down. There's Biocon, wherein the US FDA has clarified insulin manufacturing unit at their Malaysia plant as OAI. That stock as well gapping down 3% lower as we speak right now. So these are a couple of stocks which are in focus. There's also earnings from a Zensar Tech, from a TCI Express. We're going to be chatting with the management of TCI Express as well. A margin squeeze coming in on the numbers there this quarter. There's Happiest Minds as well, which also is in focus this morning. That stock will just come up for you on your screens as well. For the index though, we're pretty much in line with what's happening across the rest of the globe, which is really nothing. Some quiet consolidation with a tad bit of a negative bias. Kunal, what's your take? Another day of consolidation?
Yeah, it seems like another day of consolidation. The Nifty futures has actually gone to discount 5.7 points so far, but still it's a discount compared to the long expiry which we already had so far for the October series. In terms of the opening trade, I'll stick to the stock which I suggested yesterday, that's ACC. That's the stock which I believe is heading towards a breakout both on the short term as well as on the medium term charts.
All right, Naresh, let's get in your take as well on the market open this morning as we're sub the 19,800 mark. What's your take and first trade that you're punching in?
So the index continues to be sluggish, but the small cap index is at a new 52-week high and an all-time high. So clearly the broader markets continue to be in favor. So nothing much to take off it unless and until we see some heavyweights taking leadership. On the stock specific side, oil and gas looks interesting, and that is where IGL looks promising. So at 485, 488, this is a stock which I will go for.